What is up guys, this is your buddy Deepak Bangar from Profitable Traders, and this video is about a very interesting rule in finance called as rule of 72. We are going to see what is this rule of 72, how does it work, why it is important to know about it, the rule of 72 compound interest formula, and the practical applications of this rule of 72 when it comes to the stock market trading and finance in general. So let's begin. If you are new on this channel and haven't subscribed, I suggest you hit that subscribe button so that you will get notified about the useful videos about how to become a consistently profitable trader and an investor in the stock market, and the videos related to the personal finance as well on this channel. So let's now first discuss about this. What is rule of 72? This is a rule which is used to calculate the time required for your investments to double in the value, or the doubling time of your investments. The formula is the time required to double your investments is equal to 72 divided by the rate of return or the rate of interest in percentage compounded annually. Let me explain you with an example. Let's say I have an investment of 10 lakh rupees and I am getting investment return on my trade investment at the rate of 8% per annum, and it is compounded per year. So how much time will be required for my this 10 lakhs to become 20 lakhs rupees? That we are going to find out with the help of this rule of 72. So it's simple. Time required will be equal to 72 divided by the rate of return in percentage, and that is 8%. So this will come out to 9 years. And this is how we calculate in a simple way this doubling time of our investments. There are multiple methods which are based on the compound interest formula to calculate this doubling time, but these are very complex and they require the logarithmic calculators or an Excel sheet to come out to this number. So this is a quick way and easy way to find out this doubling time for any average person, and it gives a reasonable accuracy when it comes to the time required for the doubling of the value of your investments. Let's now discuss about where exactly this formula has come from. So in order to get to this number, we have to first understand how the compound interest works. There are two types of interest which are given on the investments. One is the simple interest, which is nothing but the interest given on your invested amount, and the compound interest, where there is the interest which is accumulated at the end of the investment period, and for the next investment period you are getting interest on that interest. So that is nothing but the compound interest. So let's first discuss about what is the compound interest formula, because this rule of 72 is derived from this compound interest formula. So compound interest formula is nothing but the amount which will be the future amount is equal to principal or the current amount, which is multiplied by 1 plus rate of return in percentage, which is raised to the power of n, and this n is nothing but the time period of the investments, or for how many years there is the investment. Now the time required for doubling of your investment, this is found out by this practical formula which you can see on the screen, and this is derived from this compound interest formula, and that is nothing but time to double, or T, is equal to natural log of 2 divided by natural log of 1 plus rate of return in percentage, that is equal to 72 divided by R. So this is how basically this 72 divided by R formula is coming. Now we are going to see the practical limitations or the applicability scenarios of this rule of 72. So first is, this rule is applicable only for those investments which are growing exponentially and which are giving the compound interest, not the simple interest. So that's compound interest where the compounding frequency is annual. Another thing is this rule of 72, that number of 72 is applicable when the rate of return is between 6 to 10%, and this rule works best when the average rate of return is 8%, but it works with a reasonable accuracy when the rate of return is between 6 to 10%. If the rate of return is more than 10%, then for every 3% of increase or the decrease, then you have to adjust this number by adding 1 to this 72 for every 3% increase in their interest rate. Let's say I have an investment which gives me a rate of return of 11%. Then from 8 to 11, so that is 3%. So instead of using 72, you have to use 73 divided by the rate of return to calculate the doubling time of your investments. Let's say I have an investment which is giving around 14% returns. Then I have to use rule of 74 and like that. Now let's talk about what are the practical applications of this rule of 72. The first application is when it comes to the investment. See, it is very common that we need this information about how much time will our investments will require to double in the value. And rather than using the complex methods of Excel or the logarithmic calculators, it is best with a reasonable accuracy to use this rule of 72 and find out your doubling time of your investments so that you can meet your financial objectives that we already saw in the example which we discussed for this rule of 72. The second practical application is when it comes to the inflation. Then this rule can be used to find out how much time will be required for your initial amount or the money to reduce to the half of its value because of the effects of inflation. Let's say inflation is growing at the rate of 6% per annum, and if you keep your 10 lakh rupees of money as it is, then 72 divided by this 6%. So in 12 years, your money will become half of the value. That means your 10 lakhs will be of value of only 5 lakhs because of the inflation effect of 6% per annum. If you talk about the daily commodities like food prices, medical, health care, inflation rate, which is generally around 10 to 12%. Let's take it as 11%. So we will not use the rule of 72 here, since the inflation is growing at the rate of 11%, which is 3% more than the ideal standard rate of 8%, which is applicable for this particular formula. So what we are going to do, we are going to add one number to this 72. So instead of 72, we are going to use 73. So your money will lose half of its value in 6 years if you do not put it to grow at the rate in an investment asset which is growing by at least 11%. So this is the second application. Third application, when it comes to the trading in the stock market, it is important to know what is the annual rate of return of your trading system or the trading strategy. And if you know that, then you can calculate how much time will be required for your trading capital to double in its value. So let's say you start your trading with 5 lakh rupees of capital, and then your trading system or the trading strategy is known to deliver approximately 21% of the returns. Then how much time will be required for your trading capital to double in the value, double in the amount? So the 8% and the trading system is giving return of 20%. So 12% more of the standard rate of return. So we have to add 4 points now to this 72. 1 point for every 3% rise in the interest rate. That is how the formula works. So 72 plus 4 is equal to 76. So 76 divided by, so your trading capital will double in approximately 3.8 years. So that's all for this video, guys. I thank you for your time for watching this video, and I sincerely hope you found this information useful and you make use of this information whenever you are assessing an investment in future about how much time will it be required. Let it be fixed deposit, let it be gold, or let it be any investment avenue. You use this rule of 72 to find out the doubling time of your investment, and then it will help you to compare between different investments. If you like what I shared, if you find this useful, please do not forget to hit the like button and subscribe to our channel. It does support us, it does encourages us to give better videos and better quality content in future. And let me know in the comments below if you found this information useful, and I would really love to hear from you about the feedback about this video and my other videos so that I can do better. And if you have any specific suggestions, please do let me know those as well in the comments below. I thank you for your time, and I'll see you in the next video. Bye.